Mortgages, everyone's favourite subject. A subject I always like to bring up around the dinner table around Christmas. Yeah, but being serious, mortgages, it's going to be probably the biggest purchase you've ever made in your life. And what that means is that this is going to be the most amount of debt that you've ever taken out in your life. So it's probably worth you being clued up about what to look out for, what various terms mean, and ultimately, how much is it going to cost you every single month if you go ahead with this. So stick about. I'm going to take you through it now in a plain and easy to understand manner. Now you may think, who am I to be giving out advice on that sort of thing? Well, a little bit about me. I've worked in private equity and investment banking for over a decade now. I'm also a professional financial modeler. In plain English, that means that I like Microsoft Excel more than I like my family. What are the moving parts here? You have 4 moving parts. You have the length of the mortgage. Actually, I should probably start with the most important bit. You have how much of a mortgage you're going to take out, and you can see a previous video on that if you want to understand how much. You have the length of the mortgage. How many years will you be taking it out for? You have the interest rate, which is a big one, always in the news. The base rate of England does this. The interest rates in the US do this. So that's a huge one. And then what's the other one? Yes, you have, are you paying off your mortgage or are you simply paying interest on your mortgage, which you might do in something like a buy-to-let. Dive in for the first time for an Excel bit of the video to go into some of those 4 I've just mentioned. I need to highlight again that this is not financial advice. I always forget to say that at the start of the video, but we're just playing with numbers. So the 4 things, these are just example figures, and we'll come back to this. We'll also come back to why there's a random graph on the screen. But the 4 things, how much mortgage you're taking out, I've used about 250,000 in this example. It will become clear in a second why. Interest rate, again, we will go into these assumptions where they've come from and what happens if you move them later in the video, 5% and 25 years. Now, the way that you can work out your monthly payment on all of those is through this formula. So it's an Excel formula, PMT, and it talks you through how you have to use it. So the interest rate here is 5. So 5 is that's annual, and we need to divide it by 12 to get to a monthly payment. So divide it by 12. Number of periods, 25 years times by 12 again to make it monthly. And PV, which stands for present value, is negative. That it's just the way the formula works, 256. When you do that, you get to a monthly payment of 1,500. Now, that is assuming, like I said, it's what's called a payment mortgage. So you're actually paying some of the mortgage back. But if you're just going for an interest-only mortgage, we'll come back to that. It is literally just whatever your balance is times your interest rate. And again, that gives you an annual figure. So you need to divide by 12. So an interest-only mortgage would be less. It would be 1,070. Now, the first thing to pick up is how big your mortgage is actually going to be. That is an entire video on itself. It's based on how much you earn. And if you want to work that out, go and have a look at my previous video. You have the interest rate at which you're going to take your mortgage out at. I'm going to show you a nice and depressing chart here of what the interest rates used to be as little as 2 years ago and what everyone has been benefiting from in the last 10 years. And then if that isn't depressing enough, I'm going to show you what that means for a monthly mortgage payment on a £300,000 house. The next thing to pick up, as discussed, is the interest rate. We've assumed 5% here, but just to get a little bit more color behind this, we need to move into another bit of what I'm showing you here, which is this area down here. So the mortgage amount you're taking out is 256, but as the benefit of taking that out, the bank is going to charge you an interest rate on that, and you're going to pay a lot of interest over the life. So in this particular example here, over our 25-year mortgage, you're going to pay £193,000 on top of what you've borrowed. So the total, these two numbers added together here, is £450,000. To put that another way, you're going to pay back 1.75 times what you've actually borrowed. Now, just so I can show you this on screen, if we look at £450,000 at 5%, this goes down to 3%, just as an example. You've gone from, what is that, 450,000 down to 365. That's almost £100,000 different. What determines this interest rate? I don't want to spend too much time in this video going into that. There's a few variables and it just gets a bit techy. But if you put down a bigger deposit, then you can get a lower interest rate. You can also fix for 2 years, 5 years, 10 years. 10 is quite rare, but the longer you're fixed, generally the higher the interest rate. It's also worth mentioning that not every single mortgage is on a fixed rate, and you have people playing around with this, trying to time the market. Most people's circumstances suits them having a fixed rate mortgage where they know how much is going out every single month. I'll put up the statistics here of how many people are on a floating rate mortgage. And what that means by floating is your mortgage moves month by month. It depends what the Bank of England does. It depends what the US economy does. So that's good for people that believe the mortgage rates are coming down and they can fit in a better fix in the future. Next part, the length of your mortgage and how that impacts how much you will be repaying. With the length, you can make the mortgage either less or more affordable depending on the length of the mortgage you take out. The standard used to be 25 years. The cost of property has gone up so much that I think the standard now for the first time is starting to get 30 or even 35 years. So again, just to give you a flavour of this here, if you've got £450,000 on a 25-year mortgage, if you stretch this to 35 years, you've gone up to £550,000. So it's another £100,000 you're paying back. That's because the mortgage is outstanding for 10 extra years. You get a bit of a benefit here that your monthly payment is down to 1,300, but nothing comes free in life because you're taking it out much longer, you're paying much more interest. And the final one, just worth mentioning, is I've basically done most of this video on the assumption that you have you're paying. I'm trying to take out the jargon here, and it's so difficult because the financial world is so wrapped up in jargon, and that's why I've decided to start these videos. So I need to listen to my own advice here. So I was going to say it's a payment mortgage. And what I mean by that is every single month when you pay, some of it goes towards paying off the mortgage and some of it goes towards paying off the interest. And that obviously has been a key theme of this video and some of the details you can look into. But not all mortgages are that. Some are interest only. This is mainly done, so you're literally just paying the interest. That means you could have a 25-year interest only mortgage. You get to the end of the 25 years and you've not paid off anything. You've just borrowed that amount and paid the interest. So you need to come up with another way of paying that mortgage off at the end of 25 years. If you're feeling a bit lost with how much of a mortgage you can actually afford, how much of a house you can personally afford, then I'd strongly encourage you to go and check out a previous video I've done on this, which takes you through on a step-by-step basis how much your salary translates to with regards to the deposit you need and ultimately how much of a mortgage that you can get. And also it tells you how much per month it's going to be, which obviously is covered in this video as well. Now, I'm sure that for the majority of you, that was an absolutely fascinating video. So if you want to be fascinated in the future with some amazing Excel hacks and some amazing interesting information about mortgages, and you can tell all your friends about your mortgage knowledge and about your financial knowledge, because it's not just about mortgages, then please come back for more in the future. Thanks very much. Did all of those sections there with this graph and referenced it a few times, and now I've realized that it's not particularly helpful to the message. I now have to go through this and explain what it's doing there. This is a little bit for geeks. I'm definitely a geek, so I may as well quickly go through this. Essentially, I keep talking about your mortgage being payment mortgage, which means some of it's interest and some of it's principal. So on the first payment, you have 1,500 of your monthly mortgage, 1,000 is interest, 431 is principal roughly. That's 70% interest. And just the way that the interest works on a mortgage, the green bars here are the interest. You can see that as you progress along your mortgage, less is being paid in interest and more is being paid in principal. And I think the thing here, I keep finding this a bit painful because of how much rates are moved. But if you look at this being 70%, if you look at a mortgage that you would have been able to get, 2 years ago or something like that, let's call it 2%, your 70% actually goes down to 38%. And just to be clear here, these numbers, this is just interest. You don't get benefit at all. This is just the interest that you pay to the bank. So yeah, perhaps a little bit too much information here but I have to talk about it now. It's in the video. I couldn't cut it out.